Today, we will talk about dilution in trading, and how it affects companies and shareholders. Dilution occurs when a company issues new shares that result in a decrease in existing stockholders' ownership percentage of that company. When the number of shares outstanding increases, each existing stockholder owns a smaller, or diluted, percentage of the company, making each share less valuable. Dilution is simply a case of cutting the equity cake into more pieces. There will be more pieces, but each will be smaller. While it primarily affects equity ownership positions, dilution also reduces the company's earnings per share, which often depresses stock prices in the market. Share dilution may happen any time a company raises additional equity capital, as newly created shares are issued to new investors. Note that stock splits do not create dilution. In situations where a company splits its stock, current investors receive additional shares while the price of the shares is adjusted accordingly, keeping their percentage ownership in the company static. Suppose a company has issued 100 shares to 100 individual shareholders. If the company then has a secondary offering and issues 100 new shares to 100 more shareholders, each shareholder only owns 0.5% of the company. The smaller ownership percentage also diminishes each investor's voting power. Oftentimes a public company disseminates its intention to issue new shares, thereby diluting its current pool of equity long before it actually does. Both the executive stock option plan as well as the acquisitions are expected to dilute the current pool of outstanding shares. Dilution protection refers to contractual provisions that limit or outright prevent an investor's stake in a company from being reduced in later funding rounds. Similarly, an anti-dilution provision is a provision in an option or convertible security, and it is also known as an anti-dilution clause. It protects an investor from equity dilution resulting from later issues of stock at a lower price than the investor originally paid. Here are 3 key takeaways. 1. Dilution is the reduction in shareholders' equity positions due to the issuance or creation of new shares. 2. Dilution also reduces a company's earnings per share (EPS), which can have a negative impact on share prices. 3. Dilution can occur when a firm raises additional equity capital, though existing shareholders are usually disadvantaged. Hope this would help. Thanks for watching.